just so you can kind of get it, they're very basic form. They have very good rates on the money market, okay? To where she's able to look at a lot of accounts and do a little analysis and say, here's what your account interest and here's what I can do for it. Okay? We had it done on K-House Beaumont as an example, and she was able to take their interest from $20,000 to about $50,000. Okay? That's a pretty nice to be able to go to a board and say, look what you're getting now, look what we can do for you. And you're going to see the rates, and they're low, in today's time, but you can get on a money market between about 0.4 and 0.6, which is still low, but right now they're getting 0.1 or 2, so you got to double or triple your check. Okay. So it's quite a nice service to be able to go to a board and say, look what we can do for you. And I think it's more in the realm of the money market. CDs is comparable, but that money market, that's a lot of people are keeping money right now. Because they're not confident with the CD market. They're not going long term. So we have a lot of money in these types of accounts. Okay. So we're all excited about it. So that's right.
You summarized it so nicely. I don't need to present anymore. Thank you. Thank you for your time today. So as Glenn mentioned, I'm with a company called FirstService Financial, and in essence, we are an affiliate of your new now company as you've merged with FirstService Residential. Basically what that means is that all of our little companies all roll up eventually to the parent company, which is FirstService Corporation. For those of you who don't know, FirstService Corp is actually a public company. It is NASDAQ and Toronto Exchange listed. One of the interesting things I always like to say about FirstService Corp is, so they own FirstService Residential. That's what, there's a couple of pillars that form their major revenue. FirstService Residential being one of them. Colliers International, if you've heard that name, is another one. So Colliers is basically the commercial property management arm. And then the third is what they refer to as FirstService Brand. And that would be something like California Closets. They own the franchise system for California Closets and some other franchise systems. They're not quite as well known here. Here we go.
Everybody will be emailed.
Yeah, so that, if you miss something, you'll get the deck. So, so basically, how did we begin? So, our mission statement, as it says there, is to leverage the total footprint, global footprint of FirstService and all of its clients in order to bring value ultimately to your clients. And it started, some number of years ago with the first kind of acquisitions on the FirstService Residential side. They basically said, well, now that we have this combined buying power, let's approach, the different banking institutions and see if we can negotiate better rates, a reduction or waiver of fees. And along with that, having all of that all of that relationship, managed through us, it has also led to operational efficiencies, which I'll explain a little bit later on. Just the one thing, and it's a really kind of our big thing for us, it's the disclosure. We always want to make sure that all of our clients are aware that we do earn a fee on any products that we introduce to them, whether it be on the banking side or on the insurance side. I'm not going to talk about insurance, but eventually that'll come. But that's sort of our main focus is banking and insurance. And so we never want clients to think that it's a kickback or anything of that nature. So we disclose up front that we're introducing something to you. Yes, we do earn a fee on it, but we feel like we do a lot in order to earn that, and we can explain that to the clients as we go along. It's usually not an issue, though. Most clients are happy for us to earn a fee if we're providing a good value to them. Well, your management agreements right now don't, and you're not re-executing them, so it's probably just the annual disclosure letter or something along the line? Okay. And anything that you get from me that will be passed on to a client has our disclosure language on it as well, including our rate sheets.
The rates are the rates. The fee is 10 to 9. They don't get out of
Right.
Important everybody understands that for Carla and her department, the non-agreed in. She'll go out and meet, if it's a big account, she'll go out and meet with the board. She's doing these analysis, that's what supports that program.
Yeah. So these are the different types of products that I deal with. So there's the traditional, what I call, sort of your operating checking, your money market reserve, and then your CDs, long-term investments. That's everything sort of, it's all banking, but, that's all the investment side. And then there's the lending side. So to the extent you've got an association that has a capital project, let's say it's a re-roofing or repiping project, something along those lines, and they need to borrow funds in order to get that done, we facilitate that process. So similar to what we do on the investment side, on the lending side, we negotiate for better terms and rates, lower fees. And I'll explain a little more also about, on the lending side, the value we add. Okay, so banking. So what do we do? Currently, we have probably nationally over $2.5 billion in deposits. I say under management, but in reality, we don't control any of those funds. So the accounts that your clients sign on to that are with our partner banks are fully in their control. It's basically us just facilitating sort of the introduction of that client to that partner bank. In some cases, the clients will have heard of those banks. They are, there is a local presence, and in other cases, there is no branch presence. But it doesn't mean that they cannot bank with that particular institution. So, okay, so where do I come in? So how I fit in is, you have a client that, let's say, you're seeing in their financials that they might be earning, very poor rates, or they might be with a broker, and most of that I've seen that are with a broker are earning, 0 to maybe 1 basis point. So 1 basis point, that by the way is 1/100th of 1%. So it literally is, nothing. And so what I'll do is I'll ask to look at their financials, their budget, and their reserve study. And what I do with that is I take a look at, we like to recommend that clients maintain anywhere from 2.5 months to 3 months of operating expenses in their checking. And anything beyond that, they should invest because there's really no need to have it sitting in checking. Secondly, we look at the reserve study and we see, okay, what is the expected sort of, schedule of projects coming up and when you're going to need that money. If it's a long ways out, we basically say, okay, well, then you have an opportunity to create a CD ladder and earn a little bit more yield. So we'll help them do that. What else? And then I won't talk much about the operating checking because that usually clients don't have an option. Once they sign up with you, they're basically forced into whatever lockbox, we mandate. And there's reasons for that, obviously, efficiencies that are created from having everyone in a single lockbox. Okay. So I talked about better rates, a reduction of fees or a waiver of fees. And the other thing that's nice for your accounting folks is a lot of our banks provide online statements. So they don't need to wait for paper statements to come through to create financials. They basically will have access to just, go on directly to the bank and pull the statements they need. Okay. So FDIC insurance. So California Civil Code doesn't mandate that all accounts be insured, but they do recommend it. So FDIC insurance basically right now is per tax ID, and it's limited to $250,000 per association. So if you've got any association with more than $250,000 in any particular bank, they're probably not insured. The exception to this for us is with Union Bank. Union Bank offers what they call third parties or excess coverage. So they've contracted with a third party to provide additional insurance for any accounts that are with, deposited with them. So in those cases, you don't need to worry about, are they insured?
Keep in mind, guys, we deal exclusively with Union. That is a program they have to opt into. Okay, so if you are with Union Bank right now, they're over $250,000. They are not in that program.
Yep.
If you recall, some of the older managers, they had that program before, and it's a lower interest rate because they have to have it insured. So we had that program, they took it away a couple of years ago. So now they're now that we're a bigger company, they're introducing it back. But understand you have to opt into it, or they'll go into that, but don't quote that you're okay right now.
So again, so these are the different types of products that we offer through our banking partners. So money markets are the traditional instruments that most associations are invested in. But as we're finding, there's a lot of associations that are too liquid, right? And so in some cases, they have an opportunity to be in longer term instruments and they're not. So that's what we're where we come in. CDs, so those are traditional. They're basically, it's like a money market, except if you're locked in for a specific period of time, which means your rate is locked in. Unlike a money market where the rate can actually fluctuate at any point in time. So the rate is not locked in because the monies are not locked in. However, with all of our money markets, what I can say is the rates that I'm going to show you have been the rates that are in place for at least over the past year, if not more than a year. What we try to emphasize with our partners is that these are not teaser rates. And when they are teaser rates, I would let you know. Like, you're only going to have this rate for this much time, and then it's going to go to this. Market link CDs, they're a little more complicated. I think I might have introduced one to one of the bigger clients that, right? So what market link CD basically is, it works just like a CD. It is fully FDIC insured for principal, so there is no credit risk. And what's interesting about them is it's the interest rate that is that is variable. So there are some clients out there that they think, oh, these rates are, they're so poor, and even CD rates are so poor, and how do I, rather than invest in a mutual fund or in the stock market or, corporate bonds, what they can do is, with a market link CD, is have the safety of their principal and FDIC instruments with the risk of the market on the interest rate, which is really what they want anyway. And market link CD could be, and there's thousands of different variations, but the ones that we normally introduce to clients are it's a rate that's tied to a basket of stocks. So let's say it's a basket of 10 stocks. And it's, for the most part, market link CDs will be minimum 5 years out to 7, 8 years. So one example that I like a lot is a JP Morgan market link CD. So it pays a minimum guaranteed rate of 1.25%. And then every year on the anniversary date of that CD, the calculation agent basically takes those 10 stocks and says, okay, what was the price on day 0 when this closed? What is the price on year 1 closing date? And if the price went up or down, they calculate the weighted average, and then they figure out, what that rate is to pay the client. So in most cases, year 1, there might not be change, but usually over time, right, the costs will go up. And so as they go up, there's a higher likelihood of the interest rate, the weighted average interest rate being higher. So the clients earn, up to 5%, sometimes 5.5% interest per year. So again, with no credit risk. So I like that instrument for clients with really large balances and no need for liquidity.
Everybody understood, there's no risk of stock market.
Right.
Aspect of TV, although your interest for the year is
Right.
Your interest is not guaranteed, but there's a higher upside, and you're more risk than
Right. No, meaning because the principal is FDIC insured. No, it means because the interest rate goes down too long. So it depends on what instrument they would pick, right? But so yes, depending on the instrument, they could earn 0 interest for the year, which is why I normally recommend the ones with some kind of a minimum interest rate guarantee. But
never going to principal.
it's never right. There's 0 credit risk. So yeah, the only thing they're risking is how much yield will they potentially earn. Oops, this happens. Okay, so this is a nice little graph I like to put up. So this basically shows the value that to the client. So what you see here, this top line represents the average rate of our program money market rate. And I want to start back in 2010 here. So back in 2010, rates were much better, as you can see. So this gap here between here and the next line, the green line, which represents the 1 year rate on CDs, on jumbo CDs. So as you can see, back in 2010, we probably offered almost on a money market instrument double the rate of a 1 year CD, right? And then over time, as rates have compressed, basically the margins have compressed, so the rates have come down. But what you'll note is that even though rates have come down, we are still offering, some value, even though it's not as large of a value. The 0% Fed rate, 25, basis point Fed rate is quite unprecedented, and we've been in this environment for really much longer than the previous time we were at near those low rates. So all expectations are 2015 rates will start to climb up, but there's no assurance of that. So okay, this is this week's rate sheet. So currently we've got 7 banks that we work with a lot more than 7 banks, but these are the 7 banks that are still accepting deposits in California. So Coffee Federal right now is offering the highest rate, so that's 60 basis points. If you were to compare that to any of the other major banks, if you walk into JP Morgan, Bank of America, Wells Fargo, whoever, you probably can only get about 5 basis points of that on your client's money, regardless of the balance. So you're talking about basically 12 times the rate that's offered by any other major provider. Coffee Federal happens to be an internet-based bank. They have 1 branch, and that's in their headquarters down in San Diego. They're, and for that reason, they're not that well known. But if you're familiar with Costco, the warehouse, Costco actually uses them as one of the lenders in their mortgage lending program. So they are reputable, and they are FDIC insured. So that's what we care about. They're also the only bank of all of our banks that requires that board signers provide copies of ID and social security numbers. So if that's a problem for any of you, there's 2 different ways that goes. There's board members that don't want to float that information through you, but don't mind floating that information directly to the bank. So we have that option. So if they don't want to provide it to you, you can say, okay, let me get you a contact at the bank, and you can provide it to them. All of our other banking partners do not require copies of ID or personal information. So it's as easy as providing them with the signature card from the bank, and they sign it, and then basically getting it back to the bank, and the account gets opened. Again, now Western Alliance is a partner that they've been a partner for a long time, but we've just gone national with them this year. And so they have the second best rate right now at 50 basis points. And I really like working with these guys. They have a lot of the president of the bank used to be a property management owner himself, and so he knows this industry really well, and so he knows what all of the issues are and quirks are. And so when he went into building this bank, he said with HOA in mind, he built a lot of things around those issues so in order to avoid them. Okay, what I normally do here, so these rates don't change much, and these are the rates to our clients net. And then down here, I usually update, this is information from the Wall Street Journal, and it's basically, you can see what the national average rates are on jumbo product. So national average money market rate, 19 basis points. So our lowest jumbo money market rate is 20 basis points at US Bank. So, still slightly better than national. But then again, they're kind of my last option versus, all these other guys.
You explain the 2 Union.
Oh, yes. So Union Bank, we talked a little bit about the excess coverage product. So If they decide to opt for a normal non-excess coverage product, it's called the premium money market. They earn 45 basis points on that. If they have more than $250,000 and they want to insure those excess balances, then they would opt to what's called an Association Plus product. And the Association Plus basically pays 20 basis points. So the cost of insurance is basically 25 basis points. So that's what the bank pays to the insurer to cover the funds. And what will happen is,
Is it the full amount that's insured or just in excess?
just in excess, because the first 250 is still FDIC.
No, I didn't mean that.
Oh.
On the interest rate, do they get 0.45 on the first 250 and then 0.2 thereafter, or is it all 0.2?
Good question. So it's the insured or non-insured option. You cannot have a client that has 250 at 45 and then the rest at 20. So they're either, it's an all or nothing. So they're either insured or they're non-insured.
Why would anybody pick the non-insured? Because you're a big account. Okay, you take somebody like Stevenson Ranch that needs to keep, say, to keep 2 months worth of operating in their checking account, they need to have $600,000. Okay, and if they cut it too low, they, to keep it FDIC insured, it's 250, and then you're taking money out of their bills and stuff, they get too low all the time. So for a big account, they'll say, okay, it's for operational use and ease. I'll take that other account because I'm going to keep X amount of funds with Union to keep it liquid to be able to pay our bills. That's why they would pick the bigger one. Important to understand, you can see the balance is over 100 grand to start with 25. Right now, most money markets are they're less than 0.4. Okay, seeing those numbers, I mean, they're not exciting. They're half a basis point.
Yeah.
But they can be 2, 3, 4, 5 times what they're earning now. So even though their earnings are minimal, you could take somebody from 10 grand to 50 grand in earnings. That's what you're looking at. That's a lot of money.
Yeah, it's always it's interesting to explain on an absolute basis, right? You're saying, what it's not so material if I'm going from 10 basis points to 50 basis points, but you have to look at things on a relative basis as well. And as the rate environment starts to creep up, that's the nice thing about these. Our expectation is that the rates to clients will start to go up as well. Which is why we tend to, right now in this environment, try not to put clients into CDs for more than 3-4 years. We don't want to lock them in for a long time at a very low rate. Okay. So lending is something that actually started, it was really, and it is still now, a bigger focus in the Northeast, because in New York City there's a lot of co-ops. There's not a whole lot of that out here in the West, and co-ops tend to, for tax efficiency purposes, like to have a first mortgage constantly on their property, because there's tax benefits for that. But for our purposes, again, I mentioned big capital projects. So if you have an association that needs money in order to fund operating, zero chance that they're going to get a loan. But if it's for capital projects, improvements, that kind of thing, buying a clubhouse or building something, that's where we can assist. So one of the things that's nice about our lending program, so first of all, right off the bat, we act as mortgage broker. We charge a 1% fee on the loan amount to the client. But what they get for that basically is, if you just need to find out if a client is even eligible for a loan, we can do that at no cost. Whereas if you needed to find out if a client was eligible for a loan, they're interested in potentially shopping a loan, you can walk to a local branch and they're going to charge you a fee, a processing fee, just for doing that. So right there, we save them some funds. The second thing is we only charge our fee if they close the loan with the partner that we've introduced. So it's zero risk for them to go through us to find multiple loan options. I like to tell this story. So I had a colleague that did shop some loans for a client. The board member happened to have a relationship with some other local bank, took our information to that local bank, and say, hey, look, this is what I'm getting from, our management company's partner. And then that particular, banker said, oh, okay, well then, I'll match that rate. So it was still a win-win for the client, right? We still added value even though we didn't earn a fee. But in most cases, clients tend to not want to bother with having to deal with, an outside party, because we basically, we collect all of the paperwork, because we know everything that's needed for the underwriting process. We collect that all from you up front. Once in a while, there may be some pieces of information that we need to follow up with, but we take that information and we funnel it through all of our, network of partners, and then a bunch of options come back, and then we'll introduce, we'll lay that out in a chart for you guys and tell you, and give you our opinion, like, okay, well, we think this particular bank is offering, the best deal for this reason. And it's not always just rate based. It could be other reasons. But for the most part, boards always go the lowest rate anyway, but.
The next part about here, guys, is we only do this maybe once a year, maybe twice. It's something none of us have an expertise in. The nice part is you're able to give it to Carla and say, here's the details, and she can come back with an analysis that's a lot more thorough than we're going to do, kind of talking to one bank. Because what we tend to do is start with one bank and you get so far down the road, that's the bank you use. Okay, versus here, you get some options.
Right. And I don't know if you guys charge any kind of an extra fee for doing that service, but I know some of our other affiliates do. And so when they use us, they waive that fee. Because it is a lot of work on the community manager's part to go through a loan process. I can skip through this. This is just so the one thing about this, to the extent that you do have a loan, and usually it requires membership approval, and it depends on the bylaws. Most of them require at least 51%, if not, what I've seen mostly is like 66, 67%, 2/3 approval kind of thing. When you have like the board meeting with the membership, like a town hall meeting, I'll attend those, or I'll have a bank representative attend those and answer any questions relating to the loan. Okay, just some general guidelines regarding loans. Anything less than 100,000, very difficult to get, just because then there's no margin in it for the bank. I'm not saying it's impossible, but if it was a key client or something, we might work a little harder to do that. Any association with less than 20 units, probably not going to be able to obtain a loan just because of the concentration risk. In terms of delinquencies, if more than 5% of the total units are delinquent, they won't get approved. And if more than 5% of the total assessments are delinquent, they probably won't get approved. So think of this similar to you going out to get a mortgage on your house, right? When you go to apply, the bank is going to look at your credit profile, right? And they're going to want to make sure that your income is enough to cover the payments, but that also you have an emergency kind of cushion in case something happens. So similar thing here. Any association that's getting ready to borrow money, the best thing they can do is start to accumulate cash in their reserves. And then the second thing is also they should have a reserve study at least annually. I don't know if all of you do them annually. Okay, I have some markets where they just say, I don't feel like doing it this year. So they bypass it for a few years until we tell them, hey, you need one. And the reserve study is important for the bank because obviously they want to look at what are your upcoming expenses and are you going to have enough cash even with this loan to cover everything you need to maintain the property. Oh, okay, so that comes, we're at the end of so again, just the key points to take away here really are know that we are a resource for you for any type of, financial insurance related questions. Even if you just want me to take a look at your client's financials and say, hey, is there anything you can do for my client here? I've got some cards here, and then my contact info should be at the end of this thing too. So, yep. And then Jamie George is my colleague in insurance. So, if anything comes up, just feel free to email or call, and we're happy to assist.
Questions?
For the loan, so basically, for the financials. Yeah. So for the financials, I normally need just your latest copy of your financial statements, which includes the bank statements, because I need to see what the rates are that they're earning. And I normally like to see a copy of the reserve study. And it depends on, if it's a client with really large balances. Like if it's less than 250,000, normally I don't need to see the reserve study because it doesn't make sense to ladder them out, right? If you've got a client with more than $1 million, really, that's when it makes sense to look at the reserve study and see if there's an opportunity there. And then I like to look at operating budgets just to figure out what is 2.5, 3 times operating expenses. If you know it off the top of your head, just include it in the email. You don't need to send me the budget.
If you ask your staff accountant, they'll send all that stuff to Carol. You don't have to put it all together. Just we can send it to you.
You have a basement, if you want to do an analysis, and I look at a balance sheet that's got $50,000, is that a waste of your time?
No, I'll look at anything. I will attend a meeting for a client with $50,000, but
We'll see what you get.
But and then that's the other thing. I don't know if I mentioned or not. So yes, I attend town hall meetings, but I'll attend your normally scheduled board meetings if there's an analysis I provided and you feel like, oh, I don't know if I want to explain this. I'll either attend by conference call or in person, depending on my availability, obviously. But it's always an option.
I think everybody should approach this, yeah, and I would say FirstService is cheap for this, when you use this paper. I would say FirstService is the fee, but the bottom line is it's quite an advantage to the customer. If you can provide analysis where they make 1,000 or 100,000 more in interest, that's the bottom line. So I'm actually looking at, I think it's particularly advantageous in today's times where there are no real interest rates out there. It'd be interesting to see how it plays out if we get back to interest. I assume it would still be slightly better. So there is room here to go and have a win with our clients. And no cost to be able to say, hey, here's one of these benefits. I'm going to Beaumont right now, and they've got on the plate, I think it's 30,000 more in interest. Now they have a lot of money, but it's a nice introduction to be able to go in and say, hey, look, nothing's changed, Dan. I just got 30 grand more. What do we want to talk about in my annual review? Like today.
Yeah. So yeah, obviously everything we show to your client is net to them. It's not like there's going to be any fees deducted from what they're being presented. That's all behind the scenes.
Yeah, where did
I don't.
Okay, so Carla will hold out for a couple minutes in case somebody has another question.
Yeah. Or you can just email me if you're too shy to ask in front of everybody.
Oh, no shy people here.
Don't worry about it.
Thank you, guys.
Thank you.
Thank you.
Oh,
I'm gonna wrap it. Thank you.
Thank you, Fireplace.
My bad.
I know, I was thinking that was the whole page for direction. They're not there in that issue. They are out on the side. And they've got quite a bit of money that needs to be invested somewhere. Have a lot of money, but we can't put any more money into the commerce because that was the they can't.
Yep.
And I'll send you their information. I would love to have you, if possible, come out and talk to you.
Sure. Yeah, let me know on the meeting.
I know what I'll send you.